Tom Boley, Chief Market Strategist here at Earnings Beats. Hey, good morning, everyone, and welcome to this Wednesday, November 8th, 2023 edition of Trading Places Live at earningsbeats.com. Great to be with you all. Certainly been through some trying times here in the market over the past, last 2-3 months, going through the correction and all. Trying to walk through with everyone as we've been going through this period, really stressing patience leading up to the bottom that we saw back on October 27th. And the market, you can tell, is just a little bit different. It's trading differently now than it was just 10 days ago. Even when the market's not going up, it just seems to go sideways. It's almost been like really boring action. And personally, as a trader, this is my kind of market. This is the market I like. I don't like the market where, you can't step away from your computer for 15 minutes. Because there's a threat of another big move to the downside. So things are calming down. We're getting to some key areas of resistance, and we're going to talk about all that and much, much more today. Giving you a quick update on futures this morning right now, and we are just a little bit less than 30 minutes from the opening bell. Right now, we've got the diamonds, which track the Dow Jones, sitting at positive about 0.1% higher. We've got the spider, which tracks the S&P 500, up just a little less than 0.1% higher. The QQQ literally flat, and the IWM up almost 0.1%. So pretty close to the flat line this morning, and that's where it's been really throughout much of the morning. So again, not a lot of, not waking up to any major moves one way or the other here the last couple of days. And overall, the market, continuing to hang in pretty well. So I think what we're seeing here is, pretty good overall action. Let's go ahead and take a look at the recap from yesterday. So we had the Dow Jones Industrial Average up 57 points, S&P 500 up 12 points, NASDAQ 100 up 141 points, mid caps down 7, and small caps, the IWM, down less than 1 point. But on a percentage basis, clearly mid caps and that IWM small caps underperforming. Meanwhile, we had a lot of rotation back into some of those large cap growth names. We're seeing big moves still from stocks like NVIDIA, Microsoft, Apple rebounding nicely after its earnings. And so all of that is contributing to leadership once again, from the NASDAQ 100. And I mentioned it yesterday, but I'll continue to mention it. A lot of folks really think that that's a bad thing, that we've got, some of the leaders leading. I mean, that's what leaders do. They lead. They're leaders for a reason. The reason that they keep outperforming everything is because they're performing better. They're more innovative. They've got better customer service. They're just better companies. And so value is going to follow companies like that. I don't know where necessarily that's a bad thing. Anyhow, NASDAQ led again yesterday. We saw a little bit less bullishness in the Dow and the S&P 500. But again, look across here. And one thing that I keep watching is this AD line. NASDAQ, as I mentioned it yesterday, emphasizing again today, taking out the tops, the last two tops, moving back, and now within striking distance of the high we saw back in July, even though we still have room to go to the upside in terms of price action. So I see that area, the large cap growth names, being accumulated again, even during this weakness. And these are the stocks that, again, are carrying us back to the upside. I don't see a problem with it, but a lot of others do. XLY, discretionary stocks, up more than 1% yesterday. Technology, same thing. Energy, though, moving in the opposite direction. Energy down more than 2%. And futures this morning, I'm seeing oil now down about a third, well, actually about a half of 1%, back to $77 a barrel. So it has fallen quite a bit from the level that we saw just within the last few weeks. 10-year Treasury yield down 1 basis point, 4.56%. That continues to drop. It's back in that range right near the 50-day moving average. We'll talk about the 10-year Treasury yield in just a minute. But overall, action, I think, has been pretty strong. If we move to the industry groups, you'll see recreational services. This is one of the leaders in the discretionary group on Wednesday, or excuse me, on Tuesday, gaining more or almost 3%. Software and hardware stocks in technology, both having strong days on Tuesday as well. Software gaining 1.6%, hardware gaining about 1.33%. So really good action across some of the aggressive areas of the market where we look for leadership. 10-year Treasury yield. Again, don't want to keep beating a dead horse, but that recent high yield came with a negative divergence. We look for 50-day test. We look for PPO centerline test. PPO just about at the centerline now. We are clearly at the 50-day moving average, which is at 4.58%. We're at 4.57 as we speak. So we are kind of in the middle of this range right now. And this is going to be an interesting squeeze here. To the downside, I think if we break below 450, that will really start giving a look like the top in the 10-year Treasury yield is in. If we bounce back up here to maybe that 20-day moving average, get up close to 470, that's where I would kind of watch, because from 470, maybe up to 480, that's where we could see a right shoulder go. If you're looking at this pattern, first of all, in order to have a reversing topping head and shoulder pattern, you have to have an uptrend. You can't reverse a trend if there's no trend in place. In this case, clearly we have an uptrend. The TNX has been trending higher and higher. Potential left shoulder, potential neckline, potential head, potential right side of the neckline. And if we move up one more time, that could be the potential right shoulder. A breakdown, whether we have a right shoulder or not, a breakdown below 450 is going to be fairly significant on the 10-year Treasury. But for now, I'm just looking at it as though we're in that range, the range between the recent low and that now declining 20-day EMA. Failures at the 20-day EMA with another breakdown would start to suggest that we are in a downtrend in the 10-year Treasury yield. Got any mortgage brokers out there listening in, or realtors probably be glad to hear that. But 445, 450, all the way up to maybe to 455, that's going to be a key floor, key support area on the 10-year Treasury yield. If we break that, I would look for that mortgage rate barometer, the 10-year Treasury yield, to fall, maybe even fall rapidly back down toward maybe 410, 420. Wouldn't be surprised. Actually, we can annotate this, and I can show you how you can do measurements. So let's just draw the neckline right here, which is this. This is the left side of the neckline. Here we never closed below. We didn't have an open or close below about 453. Intraday we did make a low below, but I like to connect candle bodies, which are opens and closes. So let's just go right there. And then what we can do is you can go in here and click on this percentage change. And then from the top here, you can drag this line down. And to get to that neckline from the top, we declined roughly 9.34%. So what I'm now going to do, if I can here, is just drag this thing down to right here, because your measurement or your target on a pattern like this is that percentage move down to the neckline. So if I start at the neckline and we get a breakdown, look at where that measurement takes us, 4.10%. And I was just looking over here at this support area around 410. That's why I initially was drawn to 410. That would also be the measurement on a head and shoulder breakdown. Now, whether or not this is truly a head and shoulder at this point, I guess it's up to interpretation. I mean, yes, we went down here. We did bounce up one day. Potentially that could be a right shoulder. It's not very symmetrical. I would like to see something back up around 470, possibly even 480, but 470 I think would do it. And then we see a breakdown. I think that would give us further clues that we are likely to see the 10-year yield drop. Now, what are the ramifications if the 10-year Treasury yield were to go all the way back down to 4.10%? Well, if you're in the camp that the biggest problem the stock market was having was dealing with higher interest rates, a trip back down to 4.10% should be pretty good for stocks. And I'm kind of in that camp. I believe the stock market was already discarding, or not discarding, but maybe, I don't know if ignoring is the right word. But the stock market, I think, was already paying little attention to interest rates. In other words, why would money be rotating into growth during this period since July with interest rates going up? I mean, I was a practicing CPA for 20 years. I did valuations. When rates are going up, if everything else is equal, rates go up, values of stock go down. That's the way it works. But not all things, are equal. And so I think what the market's doing is reacting. Maybe the GDP growth number of 4.9% wasn't that surprising based on what the stock market's been telling us. Yields have been going up, but growth has been leading value, which is a little unusual, but not unusual if growth is expected to go up enough to more than offset the higher interest rates. And I think that's what the market's been telling us, that the economy is not nearly as weak as people think it is, or that people think it's going to get. And as a result, you've got the big Wall Street firms moving in to those income or into those growth-oriented areas of the market, while the masses are selling out of them because they think, hey, we're going to have a recession down the road or whatever. I don't think the market's telling us that. And so I listen to the story of the charts, and I'm going to stick with my belief that we're going to roar into the end of the year. We're making up some more ground to the upside. I think as we look at the S&P 500, which I will show you now, I think here in the fourth quarter, we're going to go back up and test that July high, which is 4,600. Is it going to just go straight up and test it? It's possible. I told you back a while ago, I really expected an explosive move in the fourth quarter. I think we've certainly begun to see that here in November. Whether or not it just keeps going up, I don't know. I'm fully invested. I'm going to stay that way unless I see something really come up that bothers me. I am going to periodically shift my aggressiveness. Yesterday, I actually sent out to members in our daily market report that the S&P 500 has a negative divergence. And if we look at an hourly chart, you'll see what I'm talking about. So annotate this. So if you notice, prices keep going up on this hourly chart, but what's the PPO doing? Going down. Is this a guarantee of anything? Absolutely not. It is simply an indication that all of our bullish momentum to the upside is slowing. I mean, you don't even need the PPO to look at it. I mean, obviously we were going straight up and now we're going up, but we're going up at a lesser rate. I probably could have told you that the PPO was lower before I even looked at it, just because our momentum has slowed. Now, there are a couple things to look for here. Number one, if you fail to hold the breakout, then you're probably going to test these recent lows. And if you test these recent lows and they don't hold, 50-hour SMA into play. So on the S&P 500 right now, we're at 4378. That 50-day is sitting down at 4277. That's 100 points lower, 2%. Now, many of you, and I always try to distinguish between long-term and short-term, because what does this mean to me if I'm a long-term trader? Probably nothing. I'm a long-term trader. I'm not trying to get in and out with every 1%, 2%, 3% move. I'm buying and I'm holding. Maybe long-term, maybe more intermediate term, maybe for weeks or months, maybe it's years. But I don't even look at the 60-minute chart if I'm long-term. Who cares? I'm looking at the daily and the weekly, maybe the monthly. Short-term traders, however, if you start when I see this, and I am a short-term trader, I say, okay, it's telling me that I've got a little bit more risk now. When I was moving up and that PPO was following suit, that's really good action. Getting through these moving averages, trading above, that's awesome. When I start to see the momentum tell me that it's slowing, that's when I say, well, maybe some of the leverage that I'm in, maybe I need to unwind the leverage and just stick, instead of a 3 times ETF tracking an index, just get into the index. So get rid of the leverage. That's what I do. I get rid of the leverage and now I'm in the QQQ. I'm in the IWM. And by the way, I'm definitely in a little bit more of the QQQ because it has been outperforming. But I'm not going to ignore the fact that the IWM does historically like to outperform. So I've kind of got both. I'm waiting for the IWM to show me some relative strength, which it hasn't really begun to do just yet. But anyway, getting back to this negative divergence, it's just telling me that the risks are elevated in the short term, not for a major sell-off, for the possibility of a 2% down move. Remember, this is going to keep rising. So we could go down over the next few days. This could keep going up. This comes down. It could meet somewhere in the middle. Maybe we go down 1%, 1.5%. Maybe we don't go down at all. Maybe the market keeps going up, which is why I'm staying long. But I use these types of signals to help manage my risk. So it's just when I get a little nervous about, look at where we are now and look at where we were back in mid-October. All of these highs coming in right around 43.80. There's the high point. That was 43.93.57. But basically, we're all the way back up to where we were in October. This is a pretty critical level, and we're there with a short-term 60-minute negative divergence. It's worth keeping in mind, right? Again, is it a guarantee? Do I see the market selling off big time and the VIX spiking back to 20? No, I don't see that. Could the VIX go back up 16, 17, 18 maybe? Market pull back a couple percent? That's possible. Again, I'm not guaranteeing it. I'd rather be long and take the chance that it goes down rather than be in cash and hope that it goes down. If this rally keeps going, which it could, and if it breaks through this 43.80 to 4,400 level, it may just keep right on trucking. I want to be in. Again, I don't have my leverage, but I don't want my leverage when I'm right up against resistance. Look at the daily chart again here on the S&P. This is a downtrend. Lower low, lower high, lower low, lower high, lower low. We haven't gone through this lower high yet. I mean, in theory, we're still in a downtrend. We don't actually break the series of lower lows and lower highs until we clear this one. So we need that 4,400. This is a big level. Now, the other thing I find important is that normally during an uptrend, anytime you pull back to the 20-day moving average, you could, or what I expect is a bounce off of that 20-day moving average and then another high. And if you notice, doesn't this look like the inverse of what we're looking at on the 10-year Treasury yield? Look at the 10-year Treasury yield. Up, down neckline, head, down to the neckline, and now we're just kind of, all right, where are we going to go? And if you look at the S&P 500, it's the opposite. Down to, this is the inverse head and shoulder. Here's your left shoulder, back to the neckline, back to the head, back up to the neckline. And now we're trying to decide what we're going to do. It's just a flip. So if you're wondering if the stock market is tracking the bond market, I would say there's a pretty good inverse relationship right now. So if the yields happen to go back up and put in a right shoulder, we're likely to see the S&P come back down, put in the right shoulder here. If yields go back up and break through 5%, that's what the bears want to see. If that happens, that's the best case scenario for the bears to see another low. So interest rates, I'm definitely keeping an eye on. Keeping an eye on the VIX. Anytime the VIX is above 20 and rising, you got to be careful. Those things are probably going to come into play if we go back and threaten that 4,100 level. I don't see it personally, not this time of the year, not based on what all my signals have been telling me. I think worst case, we go back and test that 20-day. That's just what I'm seeing based on everything I'm looking at this point. The NASDAQ 100, I mean, pretty much same thing, right? Lower low, lower high, slightly lower low, lower high, lower low. And where are we now? Trying to take this high out. Pretty darn close. We've done it on a candle basis. The candle body, we actually had a close yesterday that was above any open or close back here. Intraday, I think we took it out as well, but let's double check this. 15,333.98, 15,335.44. We took it out by about a point. That's not exactly breaking out in my view. So we have not yet broken out, in my opinion. Another big day on the NASDAQ would do it. That to me would be more confirmation that the correction is over. I wrote about it this past weekend, or maybe the weekend before, and said correction is over. That's what I believe. I mean, I write and I say what I believe. I don't hem and haw. I don't, just kind of waffle back and forth. I'm going to tell you what I think. I think long-term, the market's bullish. I think short-term, we were in a correction, and I think it's over. And I think we're going to have a pretty nice finish to the 2023. IWM, this one still got work to do. And this is why I'm not heavily weighting it at this point. We had a nice move up to the 50. A lot more of it was gaps, though. Look at the NASDAQ. We had some gaps, but we had some pretty nice candles on the way up as well. S&P 500, same thing. We had some gaps, but we had some nice follow through during the day. IWM, it's like we finished strong last Thursday. We had a big move on last Wednesday. We had a big move, big gap up and move on Thursday. Same thing on Friday. But look at what's happened this week so far. I mean, I'm not seeing any hollow candles. It's unlike what we're seeing on the NASDAQ S&P 500. And so intraday, we're just not seeing the strength. And if I pull up the IWM QQQ, just to see how these two are going, the IWM is still down near its low relative to the QQQ. And even over the last 5 days, you can see that the performance of the outperformance of the IWM over the QQQ basically came at the opening bell or in the first few minutes of trading. Here we were up a little bit the rest of the day. Here we were up, down. Here we were down, down more. Here we were down, down more. I mean, we're not seeing intraday money rotating into the IWM. And so as long as that continues, I'm going to have some of the IWM, but I'm going to have more skewed toward the QQQ. Or the S&P would be fine. It's just the S&P is going to probably be between the two. So I view the IWM and the QQQ as being a little bit more aggressive. And so that's where I tend to stray. But that's, again, just the way I like to trade. Transports, I really like now 2 days in a row coming down below the 20-day and holding it both days. Yesterday we gapped down, but we closed right where we opened. That's a doji. And we again tested that 20-day. I think we're going to bounce off of this and head for the 50. Could be wrong. Short-term calls are a little bit more difficult. Well, they're a lot more difficult, in my opinion, than long-term calls. But we'll see how the day and the rest of the week unfolds. All right, let's move on to the chart of the day. So every day that we do the show, we have a chart of the day. And of course, our Earnings Beats Digest newsletter is a free newsletter where we have a chart of the day that goes out Monday, Wednesday, and Friday. And to get that, all it takes is a name and an email address. Hit that subscribe button. No credit card required. You can unsubscribe at any time. This is completely free. Don't know how I could describe it anymore. I try to give back to the community. I'm going to show you a chart here in 3, 2, 1. Schlumberger. This is the one that I featured today in the EB Digest that I mailed out. And I got to tell you, now energy, I tend to stay away from energy just because I find that it doesn't follow technical analysis as well as some of the other areas. And it's just influenced by things out of our control. Our market makers don't control what's going on in crude oil prices over, and what's going on over in the Middle East and all the geopolitical tensions and what might happen overnight. And those things can have major impacts on equities that technical analysis just you can't predict it. It's too unpredictable. So just again, my personal strategy in looking at the market, it's not that I won't trade energy stocks and material stocks. I just don't trust them. I've been burned by them so many times. And sometimes I'll get in at a great entry point, or at least what I think is a great entry point. The stock market goes up and energy gets crushed. And, I'm just like, why did I get into energy? Why did I do this? I just torture myself once in a while. But let's go beyond all that. Let's look at Schlumberger here from a technical perspective. Rising clearly in an uptrend. Get up here. That's the left shoulder, neckline. Here's your head. Here's your neckline. Here's the right shoulder. Pretty symmetrical. Left shoulder, neckline, head, neckline, right shoulder, back down to the neckline, holding, failed to get back through the 20, and then boom, yesterday happened. Big move down. Look at the surge in volume. This, I think, is really important, and I don't think is looked at enough. When you break down out of a pattern or break out of a pattern, you really want to see that confirming volume. That just tells me, it really just beats me over the head that, hey, this is a bearish situation we have here. And all of that selling to drive the price down to close at or near a low, big red filled candle. That's telling us the selling was pretty much all day. And then we get this big volume to boot. Let's look down here. Look at the AD line, which since late July, since the market has been downturning, this AD line actually is held until yesterday. AD line moved to a new low. How about relative strength versus its peers in energy? Settled low just recently, and even as it bounced, see this little bounce right here? One thing that makes that bounce look a lot weaker is the fact that we're going down in relative strength, and the group overall is going down. This is not good action on the part of Schlumberger. And then look at what just happened. Relative breakdown, 52-week low. The group relative to the S&P 500 moving to its lowest level since back in July. So you've got a weak group, and you've got one of the weakest stocks in the group that just broke down on heavy volume out of a bearish topping pattern. Now, this might be the poster child. Maybe Schlumberger just takes right back off and maybe underscores my point about how unreliable technicals are with Schlumberger. But I can just tell you, when I see all of this taking place on a chart, I have no incentive whatsoever to buy. I have no bullishness in my bones right now on Schlumberger. Would I short it? No, because I believe we're in a secular bull market and we're advancing. My money is going to be on something long. I don't waste my time trying to catch shorts in a bull market. So again, that's just my opinion. Everybody's different. Certainly if I were going to go long, if I was going to go short, I'd like to see actually a lighter volume bounce back up closer to the neckline, and then a close over the 20-day would be my stop. Not taking any chances. But a light volume move back up to 55, then I think the reward to risk is on your side, because let's do the measurement here. So again, we go from the top. Maybe it won't be perfect, but be pretty close. Say roughly 10, 11%, right? Let me grab this now, drag it down here, because once we break out or break down below 55, you can see our measurement goes down to what? 49.5. Well, if I were to put in support areas on this stock, that where we had this big volume day and all the buying came in right from the open, I would put there, and then this prior high becomes support. So those would be the two areas that I'd be looking for support. Look where the measurement comes down to, right down to the breakout level. So I think this is a stock that could go back down to around the 49.5 area. So if you get it back at 55, you only have a couple of dollars to the upside. You get stopped out. To the downside, you've got maybe $6. So you got 3-to-1 reward to risk. What do you have if you get in here at 53? You got $4 upside and maybe $3 to $4 downside. It's a 50-50 coin toss. That's why, for me, if I was going to short it, this would be on my watch list. I might even set an alert. Let me know if this stock goes above 55. Stock charts, you can set alerts. use that to help with your patience. So set the alert, goes over 55, see what happens from there. But that'll at least tell you it's getting back close to the breakdown level. All right, let's keep moving here. I got a few charts. It is 9:30 right now, but I want to go through just a few charts with you. I'm trying to update the strong earnings chart list. I updated it through the prior week, like a week ago Friday. Now I'm trying to update it through literally, I think, through Monday's close. And hopefully we'll have that done later today. But anyway, in the meantime, I wanted to just show you some different charts as I was going through and looking at the strong earnings chart list, and then also looking at just other stocks. These were just some things that when I saw it, I just jotted the stocks down. It's like, okay, this would be a good stock maybe to talk about for a second. So DVAX, Dynavax Technology. Now, I don't know if this was a earnings day. I think it was, which would make sense because I've been looking into last week. I was doing earnings. But look at what happened to this stock. Now, I would say that this is pretty good indication. This is resistance. Look at those candle bodies up here. What did we do here? We gapped up. We traded intraday like we were breaking out. That's a breakout, right? Intraday, it was a breakout. I don't know, morning is probably when we were up there. But if we looked at it early in the morning, we would have had a hollow candle. It would look like, here we go. Because remember, we opened here. So this would have been a solid hollow candle going through resistance. It would have looked like a breakout. What's it look like now? Looks like a failed breakout to me. That's why when you get these tails up above key resistance, if you go in, personally, I would be looking at any kind of a pullback back into this trading range as maybe a little bit of a warning sign, because look what happened after it failed. Right back down to support. Now, let's see what happens here, but I actually like the stock here. Now, I don't recall if it was, let me see if I can see if it was on my strong earnings list. This is DVAX. Yep. It looks like it beat both top and bottom line, failed, and then has come back down to support. I think this is an interesting level to get involved in Dynavax. And let me update this and just see what it's doing today. Yeah, down a little bit. You know what would be interesting is if it takes out this tail to the downside and then reverses back up. So this is one that maybe you take. I might think about taking like a third of a position, and then if we actually get that rebound, and this is one I'll talk about at 10 o'clock. By the way, we do a live trading room that starts in 27 minutes. That's for all of our paid members. So check us out. You can do a 30-day trial, a free trial. Well, we don't have. Here we go. Right here. Start your no-cost 30-day trial. We got a lot of stuff coming out, by the way, over the next month. This would be a great time to be a trial member. And then come on into the room, because I actually have a number of stocks I'm going to go over. This was one of about 12 that I had written down here. And this is just the first one. But DVAX is one that's pretty interesting. And then I wanted to also take a look at FLR. FLR, this is actually one that after I talked about it when it had this hammer, I didn't end up getting in, but my son did, Tyler, who produces the show here. And the other day after he got in, I gave him a call, or we were talking, and I said, hey, by the way, FLR is up at resistance. It's at the ceiling. It's kind of interesting. FLR is at the ceiling. But anyway, it went up, and I said, this is a great time. Take your profits. I said, maybe it breaks out, but this is the time that it could easily sell back off. So he sold off yesterday when it was coming back down. I said, all right, get ready. Maybe jump back in, because that failed breakout, it had a strong report, but failed breakout, comes back down. I think this down to 33 right in this area is a key area of support for FLR. Anyway, I'll look at some more of these in about 25 minutes. Let's see what the market's doing, and then we'll wrap up. We got the NASDAQ moving back to new highs. Remember, S&P 500, 4,400, and 43.93 was the high. So if you see 43.94, technically, we have taken out and gotten rid of that downtrend. That downtrend is over, technically, if we hit 43.94. Now, that's going to be a very thin breakout. I really would like to see the S&P get through 4,400 and keep pushing higher. So that's what I'm looking for. But just let you know, we're getting close here. Small caps are down. So small caps continue to kind of, fall by the wayside. Let's see what they're doing here. Yeah, I mean, they're going in the opposite direction. And during the day, maybe today's the day where it flips and goes the other way. But I was just showing you last few days, if they're going to make their move, it's been usually early in the day that money has been rotating away from small caps during the day. So that's one thing I watch every day, being an ETF trader or even a leveraged ETF trader, is I really want to watch that relationship during the day. Because if I see money start rotating more into the IWM, I will become more aggressive on the IWM. Until then, I think it's better to pay attention to the NASDAQ. The VIX down another 1.75%, 1455. This is not bear market material. You need the VIX. If you're a bear, you really need the VIX at least above 17, preferably above 20. 14 is a no good kind of a area for the VIX. Just go back and look at bull markets. Bull markets see the VIX just keep creeping lower and lower and lower and lower and lower. And the stock market keeps getting more boring and boring and boring and boring and boring. That's an environment that is literally, it's a bear cemetery. So you don't want to be in that cemetery. Anyway, that is it for me. I appreciate everybody tuning in. Again, we're going to start in just 23 minutes. Come on in, check it out. I think you'll really like the way we approach the market. And I think if nothing else, I think risk management really shines as a member of earningsbeats.com. Anyhow, have a great day, everybody. If I don't see you at 10 a.m., I'll see you tomorrow morning on your next Trading Places Live. Happy trading.